So the Fed is in its quiet period. We've obviously got a whole lot riding on the Fed, but that doesn't mean we can't break down the next few days, talk about the market, and feel a little bit more confident going into that Fed meeting. So over the last few days since our last video, we've seen a little bit of a pullback in the market. It's gotten a little bit more extended. We're now 5 consecutive days in the red. And let's take a look at where we're coming from. We're coming from a massive move that occurred basically in an hour on the market just trying to hear what it could possibly glean as dovish from Powell. But I've since watched that video 3 or 4 times. It began as his progress report, the FOMC's progress report on its fight against inflation. And that, as he says, begins with the reality that inflation remains far too high. And they've seen no progress on inflation, how they've seen PCE come in a couple tenths above 5%, come in a couple tenths below 5%, but not necessarily go up or down, just continue to move sideways. That forecasters in the market are projecting a peak in inflation, but they have been wrong for a very long time, as has the FOMC's projections been wrong for a very long time. So, whole lot of hawkish talk, in my opinion, out of that meeting. Regardless, the market gave a 1-hour strong rally, and ever since then, we have been pulling back, and at least over here in left-skewed investment management land, been benefiting from that. But where is the market relative to where it should be? Well, the market is anticipating a peak Fed funds rate below 5%. It just so happens that the Fed is being incredibly articulate about their desire to get the peak Fed funds rate above 5%, and into a 5 to 7% range. So that is market shock number 1 that can occur. That is a market shock that can come. That's the rate side. We've continued to get rate shocks all year. We started the year expecting 125. Then we said, 50. He took 75 off the table. Then we got 4 consecutive 75s in a row. Now we're probably going to get another rate shock that raises the peak Fed funds rate that we're probably going to target and hit. Oh, is there a ginormous stain on this shirt? That is bizarre. I have no idea what that's about. It's not just the lighting. Okay, whatever. Please ignore that. Please stay focused and centered. Excuse me, because I was the one who got distracted. Sorry about that. Very strange. Anyways, rate shock to the markets based on what's being priced. The other shock is earnings. I heard today that at the peak, mega cap tech was priced at 28 times earnings, a reason why we avoided it for months and months before the peak. We just felt it was too expensive. It was quite expensive to put that cash aside and wait essentially 28 years for a return on that cash. And we thought, peak pandemic, best earnings, et cetera, et cetera, et cetera. The earnings have stayed strong, but they're starting to come down. They're definitely starting to grow less. You can see that in Apple. I mean, we know these numbers are going to be down because lockdowns and whatnot in China. There's a whole lot of reasons for this. But they're now at 21 times earnings, but we expect earnings to come down. So it's very possible they could get back up to 28 times earnings, which was how the market was pricing them when they had tremendous growth rates. Now they don't have tremendous growth rates. Now they've been exposed as not being completely impervious. There was this whole notion that bond yields were so low, there was no alternative, that, guess what? Apple, which pays a dividend, Microsoft, which pays a dividend, they happen to be alternatives to bond yields. They offer growth, they can offer dividend growth. They're an asset, different than a bond. So, there's a bunch of forces involved in these. We've seen with the rate shock, with inflation, wages remain stubbornly high. Wages are growing less than income is growing. That is a concern on 2 fronts, both on the earnings front and the inflation front, because they're growing at tremendously high rates. They actually re-accelerated last month to average earnings coming in 8.4% year-on-year annualized, but month-on-month annualized. So I believe it was 0.7% times 12, 8.4. And then spending, because that 8.4 was income, spending was up 0.8% times 12, 9.6%. So that's what happened. That's what's happening. I am still negative. I think, we were at the peak roughly 14% from the all-time highs, which are definitely too high. That's a start, but that's not enough to address very high inflation, rapidly increasing bond yields, and an economy that needs to slow and a labor market that needs to slow. That's just, and a just giant shift from funnel hosing cash. That's like what's been going down. So it's a big pivot, quantitative tightening. It's a tumultuous time. We're remaining defensive. We'll see what happens. That's today's video, and until next time, peace out.